Introduction: the system for real markets. If you're tired of complicated trading strategies that promise the world but never actually work in real, live markets, then you are in the right place. Most retail traders fail, not because they don't study, but because they are studying the wrong things. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you. Today, I am going to teach you a simple, yet incredibly powerful trading strategy that even absolute beginners can understand and use immediately. You do not need 20 different lagging indicators. You do not need a massive trading account to start. All you need is a completely clean chart, strict personal discipline, and the exact step-by-step method I'm about to show you. This strategy is built on the core mechanics of how the smart money actually moves the market, not on retail textbook tricks. Once you understand this, you will never look at a chart the same way again. Part 1. How institutional algorithms actually work. Let's begin with the absolute foundation. We have to understand how institutional trading algorithms actually operate behind the scenes. Big banks and institutions do not enter the market using the same execution rules as retail traders. They cannot just click buy or sell with millions of dollars without causing massive slippage and ruining their own entry price. Instead, their advanced algorithms are engineered to track one single vital element on the chart: liquidity. In simple terms, liquidity is nothing more than clusters of stop-loss orders and pending limit orders waiting in the market. The majority of retail traders place their stop-losses in very predictable areas. They place them right below obvious support levels or right above obvious resistance zones. This predictability is exactly what the institutional algorithms target. Once a significant amount of liquidity builds up in a specific zone, the algorithms launch a sudden, aggressive push. This is often seen as a fake breakout or a very long wick that spikes through a key level. This spike is designed to intentionally trigger all those retail stop losses. When your buy stop loss is hit, it automatically converts into a market sell order. The algorithm absorbs these massive sell orders to fill its own large buy positions at the best possible price. This is a liquidity sweep. Immediately after this happens, the price snaps back in the opposite direction. Retail traders are stopped out, while the smart money is in a highly profitable position. Part 2. The 3-phase smart money cycle. To make this actionable, we use the sweep and flip protocol. This protocol is based on the 3-phase smart money cycle. Phase 1. Load retail liquidity. This is the accumulation stage. The market moves sideways, consolidating in a tight, quiet range. To the retail trader, nothing exciting is happening. But beneath the surface, the trap is being set. Retail traders begin placing their stop losses above the range high and below the range low. Phase 2. Trigger the trap. This is the manipulation stage. Institutional algorithms launch a sharp, sudden move that breaks out of the range. Retail breakout traders jump in, chasing the momentum, while the stop losses of the range traders are aggressively swept. Phase 3. Execute the real move. Once the liquidity has been collected, the algorithms flip their direction. They execute their real, high-volume orders in the opposite direction of the fake breakout. The price aggressively reverses, leaving everyone else behind. Our goal is to wait for Phase 2 to complete and join the market exactly at the start of Phase 3. Part 3. Case Study 1. ZOS Buy Setup. Let's look at a live chart example on the XAU-USD 1 5-minute chart. To trade this strategy, we use a precise timing window. This setup is most reliable near the end of the Asian session and moving into the London Open. We will use a clean, free trading view indicator called Sessions by JuniorFX Addict to clearly highlight these sessions. Under the style settings of the indicator, uncheck the New York session. Set the Asian session color to red and the London session color to green. Now your chart is clean and highly visual. Step 1. Mark the most recent Asian session high and low. This defines our accumulation range where liquidity is currently building up. Step 2. Drop down to the 1 5-minute time frame and wait for the London session to open. Look at what happens immediately after London opens. The price drops sharply, breaking below the Asian session low. Retail traders see this break and start selling, thinking a downtrend is beginning. But we stay patient. Within the next candle, The price aggressively reverses, pulling back and closing firmly inside the Asian range. This is our liquidity sweep. Before we enter, we must perform a quick top-down check on the 1-hour chart to confirm our directional bias. We switch to the H1 chart. On the H1 chart, we see that the market is in an overall uptrend. Recently, the price pulled back into a previous resistance level, which is now acting as support. A strong bullish rejection candle has formed at this support. This gives us our higher time frame bullish bias. We switch back to the 1-5-minute chart to execute. Part 4. Systematic Execution and the RR Rules. We enter our buy trade on the closing of the 15M candle that closed back inside the Asian range. Our stop loss is placed slightly below the low of the liquidity sweep. Our take profit is set at the next key resistance level, ensuring we target a minimum 2-to-1 reward to risk ratio. This brings us to the second most common mistake traders make, trading with a poor reward to risk ratio, a 1-to-1 R. R is a statistical trap. When you factor in broker spreads, commissions, and occasional slippage, a 1-to-1 ratio means you are slowly losing money, even if you have a 50% win rate. Professional traders look for high-value setups. In our XAU-USD setup, we actually targeted a 4-to-1 reward to risk ratio. This means for every dollar we risked, we stood to make $3.40. When you trade this way, you only need to win 35% of your trades to remain highly profitable. Look at the chart. Price rallied cleanly and hit our target with ease. Part 5. Case Study 2, XAU, USD, Short Setup. Let's look at another example to cement this concept, this time on the XAU 15 minutes chart. First, we identify our red Asian session box. We mark the Asian high and the Asian low. At the London Open, we see price aggressively shoot upwards, breaking above the Asian high. Breakout traders are buying, thinking the price is going to the moon. But the very next candle closes aggressively back below the Asian high, leaving a long wick. This is our bearish liquidity sweep. Before executing, we switch to the H1 chart for our top-down confirmation. On the H1 chart, we see that the market is in a clear downtrend. The price has recently rejected a key resistance level and is headed toward a demand zone below. This confirms our bearish bias. We switch back to the 1-5-minute chart. We enter our short position immediately on the closing of the candle that closed back inside the range. We place our stop loss just above the high of the liquidity sweep. Our take profit is set at the recent Asian low support area. This trade gives us a clean 4-to-1 reward to risk ratio. As you watch the price unfold, you can see it drops cleanly with no drawdown and no stress, hitting our target perfectly. This is the power of the sweep and flip protocol. If you ignore the higher time frame direction, you will lose. But if you align the time frame context with the lower time frame sweep, the results speak for themselves. Conclusion and your next steps. Stacking lower time frame execution with higher time frame direction is how you survive in this game. If you found this institutional breakdown valuable, make sure to like this video, subscribe to the channel, and hit the notification bell. Try backtesting this strategy on your own charts and see the difference. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you. Thank you for watching, stay disciplined, and I will see you in the next masterclass.